Hi, this is Ryan Urban with Alpha Financial and the book The Business Owner's Guide to Money. And this is a quick look at cash balance plans. First of all, before we get too deep into this, let's look at who should be looking at cash balance plans. When you look at the numbers, you'll see that these are really not going to be for everyone. The best candidates are business owners and business partners who are looking for large tax deductions, significantly accelerated retirement savings, and when you look at the numbers, you'll see what I'm talking about. Also, the ability to contribute more than the standard plan maximums. Right now, the maximums on a 401k, for example, are $54,000. Over age 50, it's $60,000. So there are people who are looking for the opportunity to contribute quite a bit more than that. Now, the characteristics of these kinds of companies, they've got to obviously have a strong cash flow. They have to have a consistent cash flow. So in other words, they have to be confident that this cash flow is going to be continuing for at least a few years. And finally, they should be prepared to commit to at least 3 to 5 years of employer contributions. An important part of this is that the IRS does keep their eye on this, and they don't want you just jumping in and out of these kinds of plans. So these plans are a commitment. Now, in general, there are two types of employee retirement plan structures. The first one is defined contribution. Now, this is where the employee is making most of the contributions. Now, typically, they're going into some kind of a mix of mutual funds. And then the owner of the company might be providing also some kind of a matching benefit, for example, 3% or 5%. But really, for the most part, these are contributions made by the employee. Defined benefit plans, the primary difference here is that the employer, you, the business owner, is the one who's making these contributions. Typically, the employee is not making any contributions to a defined benefit plan. Now, some examples, a 401k is a defined contribution plan. That's mostly the employee with some potential employer matching. A simple IRA is a defined contribution plan. Again, they're similar to a 401k in that the employee is making most of the contributions and the employer is making a slight matching contribution. Typically, this simple IRAs, and we go into this in a different video, typically the simple IRAs have a much lower maximum contribution, but they're still a nice plan to have for most companies. An SEP is a defined benefit plan, and with an SEP, the employer is making all of the contributions, and also with a profit-sharing plan, the employer is making most of the contributions. So again, we're looking at defined contribution and defined benefit. Now, a cash balance plan is essentially a hybrid. First of all, it is a qualified plan, and that means it qualifies under ERISA rules for tax deferral and for creditor protection. Now, many employers will add a cash balance plan to an existing 401k, and we'll go over those numbers here in a second. It is a defined benefit plan, so the employer is making all of the contributions. Now, each employee's account is credited with employer contributions and a guaranteed growth rate written into the plan. So that is compared to, for example, a 401k, where the employee is investing in mutual funds and they're deciding on the mutual funds, and the mutual fund or the return they get is essentially based on how well the mutual funds perform within their 401k. In this case, the owner is making the contributions, and written into the plan is some kind of a guaranteed growth rate. It might be 3%, 4%, 5%. Obviously, the higher that percent, the more at risk the employer is. And so that has to be a very careful consideration when these are put together. Now, here's where it gets interesting. The same employer contributions do not have to apply to all participants. So essentially, every individual participant is getting their own individual plan. All employer contributions are tax deductible. And so what typically happens is an ownership team, let's say you have a couple of partners, well, they can receive contributions from the company for much higher amounts than are usually allowed by 401k plans and other plans. Well, How much can a business owner or partner have contributed into their plan by their company? Well, first of all, it depends on their age. So the older the participant, the higher the maximum contribution. So let's look at that in a real world scenario. Let's say you're 60 years old, you make a good living, there's a lot of cash flow in your company, but you've just never gotten around to really aggressively funding a retirement plan. Well, the cash balance plan is quite possibly going to be perfect for you. So what's that maximum contribution? I hope you're sitting down. Per year, it's $260,000. So now remember, this is based on age. So here are a couple of examples based on the age, and let's say that we're talking about the owner here. A 40-year-old owner can put as much as $82,794 into one of these plans, plus $54,000 from their 401k for a total of over $136,000. This is why a lot of people will piggyback a cash balance plan onto the back of a 401k. At age 50, you can put up to $141,425, which gives you a total. Now, you'll notice that the $60,000 from the 401k, that's higher because at age 50, you have the catch-up contribution. So that means a maximum of over $200,000 if you're age 50. Age 60, the maximum $241,574, which means you can put over $300,000 away per year under a cash balance plan if you're age 60 and above. Those are very, very, very attractive numbers. And of course, we can help. Alpha Financial can assist with the wide range of financial issues that face business owners. You can find us online at www.alpha4business.com, and you can reach me directly at 719-659-9190. We can work together in person or online. Thanks for joining us.